Hello everyone, welcome to Real Estate and Mortgage 101. This is Module 1, laying the foundation. And so in this first module, we're going to walk through the exact starting steps of the home buying journey so you can approach your process with clarity and confidence. My name is Dr. Kevin Shuford, the property professor, and I will be your guide on this journey. So Module 1 is broken down into 3 lessons. First, we're going to talk about the 5 stages of the home buying process, giving you a bigger picture roadmap overall. Then in Lesson 2, we're going to talk about how to get pre-approved for a mortgage and what lenders are actually looking for when you're applying. And then Lesson 3, we're going to talk about what closing costs really look like and mean for your budget. And so a few reasons why these lessons are important. Overall, it's going to help you build your confidence in the process because there are a lot of new terms, there's a lot of uncertainty, there's a lot of stress and emotions tied up with buying a home. It's a very big purchase. And so having confidence in knowing what you're going to be getting into beforehand is a way to help you out. And then also it's going to help you reduce some costly first-time home buyer mistakes. And we'll get into those. I don't want to talk about them too much right now, but they do exist. And then finally, just having a clear roadmap of where you're going to start and what the process is going to look like, where it's going to end when you actually get your keys. That is what we're going to be talking about here. And so I hope you're ready for Lesson 1. So here it is, Lesson 1, the home buying process, how it really works. We're going to be talking about the 5 stages of buying a home. So one of the problems with home buying for the first time is that the process feels pretty overwhelming. You're not really sure where to start. You're not sure how much money you actually need. You're not sure what happens after your offer is accepted. You're not sure what the inspection process looks like. You don't know what an appraisal is. All of these things happen during the process. And if this is you, then you are not alone. But the good news is that the process actually is very predictable once you're able to see the bigger picture. So let's go ahead and dive into that. As I've mentioned, there are 5 main stages to purchasing a home. First is going to be the pre-approval process where you're going to get approved by a lender to see how much home you can actually qualify for. Then you're going to start house hunting. So this is actually looking at homes online, then taking tours of homes. Then step 3 is make an offer. This is where negotiations come into play. This is where your agent really is supposed to be doing their best efforts to make sure that you get the best deal possible. Then stage 4 is going to be the escrow and inspections. So once you are approved for that offer, then you get an inspection done to make sure the house actually is good to go. You then also are going to be going through the escrow process, which is making sure that everything with the loan lines up, that the house gets appraised and is actually worth how much you're buying it for. And then finally is closing. So there's a difference between signing for your house and then actually when you're able to get the keys. And so with this roadmap, the entire journey is going to feel more manageable for you, but we're going to dive into each of these stages a little bit further right now. So stage 1 is the pre-approval process. This is where you're going to apply with a mortgage lender to see how much home you can actually qualify for and afford. So when you do this, they're going to ask you for a couple documents. They're going to ask you for things like your bank statements, for your pay stubs. They're trying to make sure that you're actually making as much money as you say you are. And part of this process can feel overwhelming because they're asking for some documentation up front, and you will also have to give documentation throughout the process before the loan is finalized. But this is really just setting the benchmark for, okay, what can we roughly afford? You get an idea of what your mortgage payment will look like based on that affordability. And I think that this stage is really important because it sets the expectation for what it is that we're going to be looking for when we're out house hunting, which is in stage 2 in just a second. And so if you, for example, are looking at a house that costs $750,000, but you can only afford a $500,000 house, then you are doing a couple things. You're wasting your time ultimately because that's not something you can afford at the current moment. And you're also getting your hopes up because you're looking at these $750,000 homes, but can't actually afford that. So during this process of trying to get pre-approved or pre-qualified, the lender is going to be looking at things like your income, your credit, and your debt to income ratio. So how much money are you paying every month in certain bills, credit cards, auto loans, etc. And so it's going to help set your budget, and it's going to make you more competitive as a buyer because sellers do prefer to have a buyer that is actually pre-approved. All right, stage 2 is going to be the house hunt. So before we start hunting for houses, If you are someone who has a realtor beforehand, then you might have said like, hey, I'm looking for a house, and they said, hey, okay, go ahead and reach out to this mortgage lender to see what you're qualified for, and then we'll start to house hunt. But for some people, they go the other route where they reach out to the lender first and then reach out to a realtor after to start touring homes. So regardless of what route you take, you will then start to work with a realtor to determine, okay, what houses are we going to see? You can be looking online at places like Zillow if you want to, but the agent should be able to set you up with a customized home search on the MLS, which is a multiple listing service, to help make sure that your home your search criteria are exactly what you want. So you're going to talk about your wants versus your needs. Do you want a single story or a 2-story? Do you need a single story versus a 2-story? Do you need 4 bedrooms or 3 bedrooms? Do you need 2 bathrooms, 3 bathrooms? Do you need a backyard? Do you need a garage? Do you want a pool? All of those things are factored in to this custom home search, and then what they do is they can set up so that you receive that home search either every single day or maybe a couple times a week. Just really depends on what you want to do, and it's on your schedule. Regardless of who you're working with, you should be aware that you are always in charge. We are here as a mortgage lender and a realtor myself. We are here to guide you and offer our advice, our opinions, to help you secure the best deal possible, but it's ultimately always your choice. So just keep that in mind. You don't have to necessarily do anything that you don't want to do. You don't have to see any homes that you don't want to see. So just keep that in mind when you're starting to tour homes. This process can be very fun, right? Going out and seeing homes in person, seeing, okay, what do I like? What do I not like? Does this work for me? Does this not work for me? And after every tour, hopefully you're starting to get a better sense of what you want, what you actually want, and where you want to be. Finally, here I'll say that if you are going out house hunting, I would recommend only seeing about 5 homes per day tops, because after that they really start to blend together. Typically, I prefer it like 3 or 4, but it really depends on you. As I said before, if you want to go for more homes than that, that's totally fine. But that is stage 2 house hunt. So we are on to stage 3 now, which is actually making an offer. And this stage can feel a little stressful because you want to make sure that you're getting the best deal possible, but you also want to make sure that the deal gets accepted. And so with your realtor, you will sit down and figure out, okay, what is it that you want to offer? What contingencies do we want to include? And what is our closing date? So the way that this works is you will say for example, we have a house that is worth $500,000. It's on the market for $500,000. We sit down and then we decide, okay, do we want to offer $500,000? Do we want to offer $490,000? Do you want to offer $510,000? You decide what you want to offer based on what you qualify for with that pre-approval that we did in step 1. It's important to note that if and when your offer gets accepted, you're expected to put down what's called earnest money. And this is basically an earnest deposit. It's a good faith deposit saying, hey, I'm willing to start this process by putting some money towards this house. And so this payment goes toward your down payment. So usually I recommend about 1% for earnest money. So on a $500,000 house, you're looking at a $5,000 down payment right at the start of offer acceptance to get the process started. This money is fully refundable as long as you meets several of the contingencies. So for example, if during the inspection period you find something that you do not like with the house, you can back out of the contract and you can get that money back. If the house does not appraise for the value that it is, so say for example, the house is being sold at $500,000, you offer $500,000, but the price comes in at $475,000. You can choose to walk away and get your money back. And then if for some reason that is no fault of your own, you do not qualify for financing, your loan does not get approved, then that would be another instance where you can get that $5,000 back. And so you don't lose any money, you've just really only lost some time. So you will then decide, okay, what the earnest money is going to be. You will then also think about how much down payment you're going to do. The down payment oftentimes is going to depend on the loan type that you have, and we'll get more into financing in a later lesson. And then you also then choose different things like your closing date. You will also say, do you want any of the appliances that are being left in the house? So washer, dryer, refrigerator, for example. You also then can tell them if you want a home warranty. And so this is basically going to help protect all major appliances if something goes wrong within that first year. It helps give you peace of mind. So this is the offer process. really here your agent should be looking at a couple of different things. They should be looking to see, is this house actually priced the way that it should be? Is it overpriced? Is it underpriced? Is it a good deal or not? And then help sit with you to figure out, okay, what do you feel comfortable offering? And just know that this could go back and forth several times. I've been in situations where we've gone back and forth and we've had 2 or 3 counter offers because the two parties, seller and buyer, would just kind of figure out, okay, where are we actually going to meet before we move forward with this? So that can happen. So that can be part of the stress that is involved there. But really what your realtor should be doing is they should be helping manage that stress for you and making sure that you feel comfortable and confident with your offer from start to finish. So that is stage 3, the offer. All right, we are at stage 4 now, which is escrow and inspections. So that earnest money deposit that I mentioned before is going to be held by a third party, which is an escrow company or a title company. They're going to take that money and they're going to hold on to it throughout the duration of the process. And so this is to make sure that the money doesn't get mishandled or misused in any way. It is safe with that third party. And so then, once you've submitted that earnest deposit, we then go into inspections. So this is also called the due diligence period. And so during this period, you have typically about 10 days, 7 to 10 days, to figure out, is the property in good condition? And so this is really important because if you purchase a house without an inspection, you don't know what you're actually getting into. You don't know what the quality of the roof is, what the plumbing looks like. And so I recommend to my clients that they typically they look for the big ticket items, 5 main ones. Primarily you have the foundation, you have the roof, you have the plumbing, you have electrical, and you have the AC, which is especially important in Arizona because if you live in Arizona, you know how hot it can really get. So during this inspection, what will happen is the inspector will come in. It will cost you a couple $100 probably for the inspection. Depends on the size of the home, depends on how much of the inspection you want to actually get done. It depends if you're going to bring on specialists or not. Depending on where you live, roofers can be free, plumbers for sewer scopes can be free as well, but it really just depends on what your agent's able to negotiate and what the prices look like in your specific area. But the inspector is going to go through the house and mark down every single thing that they see that is wrong with the property. And this is going to be things like, oh, you're missing a door handle here, or the latch on this doesn't lock, or this is a hole in the wall here, to things like this roof is terrible and needs to be fully replaced, or this AC is not cooling the way that it's supposed to. So there will oftentimes be a very long report, and this can stress some people out because they think, wow, there are so many issues with this house. But I hate to tell you this, pretty much every house you're going to get into, even new build homes, are going to have issues come up during the inspection period. Really what you're looking for here is, what things are you able to potentially take care of for yourself or by yourself? What are some things that maybe are just more cosmetic and don't really matter too much about the quality or the structure of the home? And then what are the items that are going to be really important for you to have the seller address before we move forward with the process? So at the end of that inspection period, your agent is going to submit what's called a BINSR to the seller. And on this BINSR, you are going to provide everything that you want to have them correct or give you a credit for, depending on your loan type and the situation, before you close on the house. There are a couple different schools of thought here. Some people say, hey, let's put everything on the BINSR and let's just see what we can get from them. But the one that I prefer to operate under is, let's really just focus on the big ticket items that we think are most important and hope that all of those get accepted. So after you submit that, the seller then has a couple different options. They can say, okay, yes, we're going to go ahead and take care of everything here for you. They can say, we're only going to take care of items 1, 2, and 3, but not 4, 5, and 6. Or they can say, we're not going to take care of any of these for you at all. If they choose to not take care of any of them for you, you can then still continue with the contract if you want, or you can walk away and get your earnest money back. Same thing goes with if they say we're going to take care of a couple of them, you can walk away and get your money back there as well. And so this inspection period is very critical. Please, please, please do not purchase a home without actually getting an inspection done on it. All right, we are here now in stage 5 at closing. So if the inspection period cleared and all the issues got addressed, that is great. If the home also appraised, which means that the lender came in and said, hey, this home is actually worth how much you are offering for it, then that is great. If the house does not appraise, I think I mentioned this earlier, then you can walk away from the contract and get your earnest money back Or what we can try to do is you can ask the seller to reduce the price to what the appraisal price is, because you shouldn't have to pay more for a home than it's actually worth. However, this does tend to happen if you are in a bidding war, for example, or if there's multiple people who are trying to get the house, or if it's a highly desired house, or if you just have extra money and you think that the house is worth it. You're more than welcome to pay more, but typically I don't recommend doing that. So the house can come in at value, which is good, which means we can move forward. It can come in under value, which means we have to potentially renegotiate and make sure that you're not paying more for the house than it's actually worth. Or in these cases, if the appraisal comes in over the purchase price, then that is great, because that means that you have instant equity in the home. So say, for example, you're offering $500,000. The appraisal comes back and it says it's worth $515,000. That's $15,000 of equity that you just got out of nowhere, which is great. So once that is done, the final loan will get approved. During this process between the end of the inspection period and closing, so if the inspection period is 10 days, the process typically takes about 30 days from acceptance of contract to close of contract and when you get the keys. So between days about 12, 13 through like 26, you're not really doing too much. You are submitting paperwork to the lender to make sure that everything is finalized. You're filling out some forms in the background, but a lot of stuff is working in the background, even if you're not actually doing very much yourself in that 2-week period. So once the loan is finalized, then what you are going to do is you're going to submit your remaining down payment, which is minus the earnest money you've already submitted. So say, for example, you're putting $15,000 down, you've already submitted $5,000 as the earnest deposit. So now you're going to owe $10,000 remaining on that down payment, and then potentially closing costs as well, which we're going to talk about in an upcoming lesson here. So hold on for that. Once the loan gets funded, you will go to the title company, or they will come to you with a mobile notary, and you will sign for the property. This can be also stressful because there's a pretty decent sized stack of papers that you have to sign, but the notary or the title company, escrow company should walk you through exactly what you are signing on each step. You should also make sure that if you have questions and you ask questions, if you want your agent there with you, you can have your agent there with you just to confirm things. So you have to just make sure that you're protecting yourself and your interests, because this is a big purchase. And so once you sign, then what ends up happening is that the title company, escrow company sends that paperwork to the county to be recorded. And then once the county records it, that is when you actually are able to get your keys. So you do not leave the title company with keys. That's typically not how it works. It's usually going to take a couple hours. It could potentially be pushed the next day when it gets recorded, depending on what time you actually sign and what time the loan funds through the lender, depending on what lender you're using, what time zone they're in. And so you do have a closing date, but that closing date can shift a little bit. So I always recommend that you just kind of be aware that the closing date can shift maybe by about a day, 1 to 3 days, depending on how things are going. And sometimes it could get pushed longer if there's other issues that get tied up with the contract. But assuming everything goes according to plan, you sign, the county records it, your agent gives you the keys, and now you are a home owner. Congratulations. So I just want to provide a quick overview of what closing costs look like. So people often say like, okay, how much money do I actually need in order to purchase a home? It's going to depend on a couple different factors. So if we're using this $500,000 purchase price, if you're going with a conventional loan, you're doing just 3% down, because it is possible to get a house for just 3% down. Some people think it's 20%, but that's not actually true. So that's going to be $15,000 for the down payment. Closing costs, which we're going to get into a little bit further in an additional lesson, these are going to be fees that are associated with the loan, with title company, homeowners insurance, property taxes, HOA fees. All of those things get rolled into that. Typically, it's going to be about 2 to 3% of the purchase price as well. So realistically, you're looking at about 5 to 6% at minimum to purchase a home. So we're going to say that here closing costs are going to be $11,200. It is possible during the negotiation period to get concessions or credits from the seller. This is going to depend on the loan type that you have. There are certain limits. You cannot use money from the seller toward your down payment, but you can use money from the seller towards your closing costs. And so if, for example, we got $8,000 from the seller as a credit for our closing costs, then we're only actually going to owe $3,200 for our closing costs, plus the $15,000 for the down payment. So we are getting into this house all in for $15,200. That's pretty good. So as a quick recap, let's just talk about what those 5 stages are once again. 5 main stages in the home buying process. Pre-approval, where you figure out, okay, how much home can I afford? Then you go on the house hunt to see what house do I actually want. Then you get through the offer process, where your agent's going to help you negotiate the best deal possible. Stage 4 is going to be escrow and inspections to make sure that the house is high quality and is going to be acceptable for you. And then stage 5 is the closing, where you're going to sign and then finally get your keys. So hopefully you understand these steps a little bit better, and hopefully you're feeling a lot less intimidated about getting this process started. So now that you've completed lesson 1, I encourage you to continue forward to lesson 2, where we're going to talk about the mortgage pre-approval process. And this is where we're going to discuss in more detail what lenders are actually looking for and how you're going to qualify for a mortgage. Hope to see you there. Very quickly before you go, I just want to say thank you so much. I appreciate you watching this first lesson. I highly encourage you to subscribe to the Real Estate and Mortgage 101 series, because I'm going to give you a lot more information to help you feel as confident as possible during this process. You can also download Module 1 for free just by clicking on the link in the description box down below. And finally, I know that this process can feel overwhelming, so I am here for you. I know that you can do this. I will walk you through every step of the way. Feel free to contact me if you have any questions or want more information. Thank you once again for watching. If you need to contact me, you have my phone number here. Feel free to text me or call me at your convenience. Email me as well. I do serve clients across all 50 states in the United States, and I have international referral partners available if you're looking to purchase in a different location. Let me know how I can assist you on this journey. I'm here for you. You can do this. Take care. Hello everyone, welcome to lesson 2 of module 1. We are talking today about mortgage pre-approval, just trying to figure out, okay, what does the process entail? My name is Dr. Kevin Shuford, the property professor. I am a real estate agent and mortgage lender in Arizona and California with referrals across all 50 states and internationally. I will be your guide here. Let's go ahead and jump into this about mortgage pre-approval. So the first step in purchasing a home is figuring out how much mortgage you can afford, how much house you can actually afford. This is going to be very important because it's going to set your budget and let you know what that mortgage payment is going to look like every single month. When thinking about what sellers prefer to have offers that are actually pre-approved and backed by a lender. If you submit an offer without a pre-approval or pre-qualification, then it's not going to be as strong as if you submitted one that had one. This is also going to help you save time and stress later on in the process, because getting an offer accepted and then scrambling to find financing can be very stressful. Sometimes there's situations where during the middle of the process, you actually switch lenders, and that is okay, it happens, but not having to worry about it after you've already started the process gives you a little bit of peace of mind. So let's dive further into this and talk about what lenders are actually looking for. So mortgage lenders are going to be looking for 4 key factors. First, they're going to be looking at your income. So how much money are you pulling in at your job? They're going to be asking you for your pay stubs. If you're buying with somebody else, then they're also going to want to see those pay stubs just to see how much money you're actually pulling in every single month. Next is credit score. And so credit score is going to vary depending on loan programs. You can qualify for mortgages if you have a credit score in the 500 range, but it's probably going to be a little more difficult to qualify and your loan is going to be more expensive. Ideally, we want to be in the 620 and above range. If you can be in the 700s, the 800s, that is excellent. You're going to get a better rate overall, which means a better price as well. And then third thing they're going to be looking for is your assets or your savings. How much money do you have in reserves to potentially cover some of the costs you're going to be incurring, like the down payment, earnest deposit, closing costs. They want to see, okay, how much money do you have in every other place, your bank accounts, your stocks, etc., just to see what that looks like. And then finally is the debt to income ratio. So we're going to dive into this a little bit further on the next slide because I think that's worth explaining a little bit more. So your debt to income ratio is one of the biggest factors in determining your pre-approval. And so we take a formula here that is you're going to divide your monthly debts by your monthly income. So for example, if you're making $8,000 a month and you have debts of $3,200 per month, so in things like your rent, these are recurring debts. So rent, car payment, maybe credit card payments, then your DTI would be 40%. Most lenders are going to want to see under 36%, but depending on the loan type and loan program and the specific buyer situation, that percentage can get a little bit higher into the 40s even, if you're actually going to be able to make it work and there's other factors that are at play there. So if you can keep your DTI under 40%, under 36% ideally, then you're going to get a better rate overall and just a lower payment. If though you have a higher debt to income ratio, then unfortunately it's going to be much harder for you to actually qualify for a mortgage, and so you might have to, in some situations, maybe pay something off beforehand to get rid of that debt completely, to then be able to actually qualify for the mortgage. There are some common myths surrounding a pre-approval, and so I just want to dispel some of those right now. One of the first ones is that people oftentimes think that if I get a credit check for this pre-approval process, then it's going to destroy my credit score. And that is actually not true. So what lenders typically do is they will do a soft pull on the credit just to get a snapshot of what it looks like right now during that pre-approval, pre-qualification process to find out how much home you can actually afford. If you decide to move forward with the purchase of a home and you're in that under contract on a house, then that is when they will actually do a hard pull on your credit to make sure that everything actually does check out. And even if you do get dinged for this, if you don't have a lot of other credit checks in your recent history, then this score drop, if it drops at all, is going to be probably fairly slight. The next myth that really drives me crazy is that buyers often will think that they need 20% down in order to make a purchase on a house. So if you're buying a $500,000 house, that's going to cost you $100,000 to actually purchase it. And that is not true. There are many different types of loan products and programs that are out there that allow you to purchase for much less out of pocket than that. So for example, with a conventional loan, you can get into a house for as low as 3% down or 5% down. So that's looking at either $15,000 or $25,000 on that $500,000 purchase. You can also go potentially an FHA loan, which is going to give you the option of doing a 3.5% down payment. So that's about $17,500 on that $500,000 home. And then even some VA programs and USDA programs can actually get you into a house without actually putting any money down out of pocket. And so you do have options here, but you need to explore them and figure out with your lender which program is going to be the best fit for you. And then finally, the last myth here is that all of your debt must be paid off before you actually apply. That is not true. Really what we want to see is your debt to income ratio workable? Can we make it so that you can afford to actually buy this house, or is this house purchase going to put you over the top to where you are feeling like you're underwater? And so if you can pay off some debts beforehand, then that can be a good thing and help you be qualified for a higher sales price on a home. But you also have to be careful too, because sometimes paying off certain things on your credit can actually cause your score to drop. So that's a whole nother conversation. If you want to know more about that, go ahead and reach out to me and I can give you more information. So I was working with a couple who had some student loans and they thought that they could not afford to purchase a house because they had those. Well, what they found out through conversation was that the student loan does not actually charge necessarily against you at the same rate as other debts like car loans, for example, or credit card debt. And so we had a conversation. We found out that, okay, you have some money coming in right now. You could pay a chunk down on some of these other loans that you have to improve your credit overall, to improve your debt to income ratio. And because of that, they were then able to qualify for a higher purchase price on a home. And so this pre-approval really is about strategy. It's not about being perfect. We need to have the conversation to figure out, okay, what is going to work for you specifically, because no one's situation is exactly identical to somebody else's. So this has just been a quick overview of what lenders are looking for. We're going to dive further into what your specifics look like in terms of loan types and programs in the next lesson. But just as a reminder here, your pre-approval is that ticket to board the plane. It's the way to get the process fully started. Lenders are going to be looking at things like your income, your debt to income ratio, and your credit score. All of those are going to factor in to see how much home you can afford and what your mortgage rate is going to be and what your mortgage payment will ultimately be as well. And then I hope that I've dispelled some of these myths that we mentioned on the last couple slides to make sure that you feel more comfortable knowing that you don't have to have 20% down in order to purchase. You don't have to pay off all of your debts either. You actually can get pre-approved for a mortgage and not take a ding to your credit. And so hopefully this lesson has been helpful for you overall. So that is going to conclude lesson 2 on what lenders look for. But in lesson 3, I think it is a very important one because we're going to be covering closing costs. So how much money do you really need, and how can you use credits to your advantage to make sure that you pay as little in closing costs, if nothing at all, if possible. And so this next lesson, lesson 3, is going to be very important and will be the way to round out module 1 overall in this overview of the home buying process. I hope to see you there. Very quickly before you go, I just want to say that I appreciate you sticking around watching this video. I highly encourage you to subscribe to the full Real Estate and Mortgage 101 series because I have a lot more lessons coming out for you to make sure that you feel as confident as possible in the home buying process. I also highly encourage you to download the full module 1, which you can do by just clicking on the link in the description box down below. There's also a lot of other resources in there that I think are going to be very beneficial for you. I know that this process can feel overwhelming, so I appreciate you sticking here, and I'm here to help you every step of the way. If you need to get in contact with me, feel free to give me a call or shoot me a text message or an email at the number and email that you are seeing on the screen. As I mentioned, I am a loan officer and a real estate agent in Arizona and California, where I do business myself specifically, but I also serve clients across all 50 states and internationally with some very strong referral partners. So if you need me, if you have questions, if you want to work with me, please feel free to reach out and I will do my best to take care of you. I'll see you on the next one. Hello everyone, welcome to lesson 3 of module 1, where we will be describing what closing costs are and talking about how much money do you really need in order to purchase a home. My name is Dr. Kevin Shuford, the property professor, and I am licensed as a real estate agent and mortgage lender in Arizona and California, but have business partners and referrals across all 50 states and internationally. Let's go ahead and jump into this and figure out how much money do you actually need. So what are closing costs? Well, when you're going through the home purchasing process, you're going to have to pay a couple different amounts of money. You're going to have to do an earnest deposit, which is what you pay to get the process started, typically about 1% of the purchase price of the home. You are also going to have to do a down payment, and so your down payment is going to depend on the loan type and program that you have. Some programs are 0% down, but typically you're going to be seeing about a 3% down or a 3.5% down, or you can go a 5, 10, 20, 50, however much money you have, it's totally up to you. But that's the second type of money you have to use. But then the third one that oftentimes people will forget is closing costs. And so what these do is they cover a variety of different aspects of the transaction, including lender fees, title and escrow fees, prepaid taxes, and insurance. So with the lender fees, it oftentimes is going to cost money for them to actually process the loan. They have to pay certain people, and so that is part of what the lender fees entail. With title and escrow fees, it also is going to cost money for people to make sure the transaction goes over smoothly. You're going to also want to pay for things like title insurance to make sure that no one can come after you to try to take the home from you because of some other dispute that exists. You're going to have prepaid taxes, so property taxes are going to be into this category here. You're going to have some other miscellaneous fees, HOA fees and dues that are going to be piled into this prepaids. And then finally, you have homeowners insurance. So you want to make sure you have homeowners insurance in place to make sure that the house is protected in case anything does happen to it. And so all of these things are added into the closing costs, but oftentimes people don't really remember to factor them in. So you might be wondering, okay, if I have to pay all these other things, how much money should I expect to have to pay? And so the rule of thumb generally is about 2 to 3% of the purchase price of the home. So if we take a $400,000 home purchase, then that means that you're going to be spending about $8,000 to $12,000 for closing costs. And so if you are going to say the same price home, you're going to be putting down 3%, which is $12,000. And you also have a 3%, $12,000 for closing costs. And that means you're going to need $24,000 cash to make sure that you are able to close on that property. which is a lot more than just the $12,000 down payment. So you need to make sure that you factor in these closing costs. So let's look at another example here. So in Scottsdale, there was a buyer who was closing on a home for $500,000, and the closing costs came out to $11,200. However, we were able to negotiate from the seller a credit for $8,000 that was then applied to the closing costs. And so that left the buyer with just $3,200 to cover in closing costs. So with this loan, it was a 3% down, so it's $15,000 down payment now plus a $3,200 closing cost, which is going to put us at $18,200 instead of $26,200. That $8,000 is a huge difference and definitely helped them feel a lot more comfortable going forward with the transaction. So now that we know what closing costs are included, and we know that about 2 to 3% is supposed to be kind of kept or budgeted as a minimum to make sure that those closing costs are covered, some things that you can do to help prepare yourself is first talk to your lender and ask them, hey, can you give me a loan estimate up front to let me know what closing costs are going to look like? They should be able to do this for you, but just note that this is an estimate, so some prices on there might change. There are certain things that you cannot shop for, and those prices should not change, but there are some things that you can shop for, and so if you choose to go with a certain title company, for example, then the lender cannot say for sure what the cost is going to be for the title company until they get more information from the title company. And so you just need to make sure that you are asking for it up front so you can get a really good ballpark idea about how much those closing costs are going to run you. And then as I mentioned, if you can budget about 2 to 3%, then you should be pretty safe overall for those closing costs. However, my biggest recommendation is that even if you're working with me, this is something I always do, but regardless of who you're working with as your agent, you want to try to make sure that you negotiate as much credit as you possibly can from the seller during this process. Depending on the loan type that you have, you may only be able to get, for example, 3% in concessions or credits from the seller, or maybe 6% or more than 6%, but it really depends on specific loan types and programs. It's also important to note that this money that you're getting in concessions or credits from the seller cannot go toward your down payment. However, it can go towards your closing costs. So it can go towards the things like the title fees, the lender fees, prepaid taxes, the homeowner's insurance. All of those things can be lumped into those closing costs credits that you get from the seller. And so depending on the market that you are in, depending on how hot the market is, depending on how many buyers there are in the market, this is going to be a really good negotiating tool for you, because if you as a buyer can get 2 to 3% in concessions or credits from the seller, then all you really have to do is worry about that down payment. However, if the market is super hot and there's multiple buyers, then asking for those credits potentially could make your offer less attractive, because now the seller's giving up 2 extra percent when the other person who put an offer in is just offering full price with no concessions. So asking for concessions can actually end up hurting you in some instances, but I still highly recommend trying to do it if and when possible. The other thing that is important about these seller credits is that if, for example, you have some extra money left over, it cannot go into your pocket after those closing costs are covered, but it can be used to reduce your interest rate or buy down your interest rate. And so that is a way to help get your mortgage payment to be just maybe a little bit more affordable for you overall. And so these seller credits, these concessions are very vital. Please try to get them if and when you can. So as I was just mentioning, let's talk about some 2025 insights that we've seen overall. So first, more sellers have been offering concessions or credits primarily because interest rates have been so high compared to what we saw during the COVID times when they were down in the 2-3%. And so if you have rates that are in the 6-7% range, then more houses are going to sit on the market and more sellers are going to start to become more desperate to sell, and therefore they're going to offer more in credits and concessions to cover those closing costs. So if you are a seller and your home has been sitting for a while, then offering those to potential buyers can make your house look more attractive because it becomes more affordable for those buyers. You can also then market these concessions as a way to help buyers buy down their interest rates, because that's really what is holding a lot of people out of the market right now is if they feel that rates are too high, that mortgage payment is too high, if you as a seller can help buy down that interest rate, then you make the house more affordable, you make that mortgage payment more affordable, and you get more interest overall. There are some other ways to also reduce some of the fees. So things like digital closings, instead of getting you get a digital notary instead of a mobile notary or going in. So that's a small way to help reduce some of the fees of the closing costs. But there is something else that I really want to make sure that you are aware of, because you may not have been aware of it until right now. So right now, in the new era that we're in, after a lawsuit that occurred in, I believe it was 2024, buyers are now required to pay their realtor or agent out of their own pocket. However, this is a change because typically beforehand what happened traditionally was that the seller paid both the seller's agent and the buyer's agent from the commissions from the sale of the property. And so while the buyer now is on the hook for that fee, it's very important to note that those fees are negotiable. So if your agent says that they want to charge you a certain rate, you can ask them for a different rate. That is definitely something you have the right to do. You do not have to say yes to a certain rate just because that's the rate they told you. Everything is negotiable. It's also very important to note that this is something that I do with my clients personally, is that while I do give them the rate that I charge and we have a conversation about it, I also let them know that I'm going to do my best to make sure that I get my rate fully covered by the seller as part of the contract. And so what we then will try to do is we try to make sure that we get my fee covered by the seller, as well as get some concessions for you as the buyer to help either buy down the rate or reduce those closing costs. So in some situations, the seller will still be open to covering your buyer agent's fee, but that's not necessarily always going to be the case. And so in some situations, if that seller's not going to cover that fee, then you have to be aware that that fee is going to fall onto you as a buyer, which is then going to increase your closing costs even more. And so, for instance, it could be a situation where the the seller is going to cover closing costs, but not your agent's fee, or vice versa. And so the closing costs, there's going to be an extra fee added on top of your down payment regardless. So please make sure that you are aware of that. Your agent should make that very clear. You should be signing documentation and contracts before you actually even go see a house with your agent. But I just want you to be aware that that can also increase the closing costs of the property. But what we've seen a lot lately is that sellers are still willing to play ball and cover part of, if not all, of that buyer's agent's fee. All right, and that will conclude lesson 3 on closing costs. So as a quick recap, closing costs are going to run you typically about 2 to 3%. They can be reduced from credits from the seller. That's something that I highly recommend. I also highly recommend trying to get your buyer's agent's fee covered by the seller with credits and concessions as well. And then to make sure that you know what it is that you're paying for and how much it's going to cost, always ask your lender for a loan estimate to get a rough idea about what that is going to look like for you. Hope you found this lesson to be beneficial, as I have a lot more important, valuable lessons coming up in the future. So that wraps up Module 1, which is laying the foundation, talking about the 5 stages of the home buying process, what lenders look for, and what closing costs are and how much to expect that you're going to have to pay. In lesson 2, we're going to jump more into the numbers side of this by talking about financing with confidence. So we're going to talk about different mortgage types and programs. We're going to discuss seller credits in more detail than we did here and talk about rate buy downs in more detail as well. And so I hope that you can join us for that, because these next couple of videos in Module 2 are going to be very important and help you feel more comfortable with the financing aspect of it overall. Very quickly before you go, I just want to say that I appreciate you sticking around and learning more about the mortgage process with us. So I highly recommend that you please like and subscribe to the full Real Estate and Mortgage 101 series, because I have a lot more information coming out for you that I think is truly valuable for this process. Please also feel free to download the full Module 1, which covers lessons 1, 2, and 3, by clicking on the link in the description box down below. And as a treat for you, if you click on that link to the Google Drive, you will be able to access a lot of other documents and information, just value-packed drives there that will help you feel more comfortable and confident in purchasing a home. I know that this process can be a lot, and I know that can feel overwhelming, so I just want to let you know that I'm here for you to help walk you through every step of the way, and I appreciate you trusting me with this journey. Finally, if you'd like to get in touch with me, then my contact information is here for you on the screen. Go ahead and give me a call or shoot me a text at the number on the screen there, or send me an email. I am licensed in Arizona and California as a mortgage officer and a real estate agent. I can work with you fully directly there and make sure that everything is taken care of. But if you live in a different state, or if you're trying to purchase in a different country, I do have referral partners that are very strong and reliable across all 50 states and internationally. I would love to help you with this process because I know that it is important, and I want to make sure that you are confident and comfortable in everything that you're doing here. So I hope to see you on the next module. Take care of yourselves.